On the morning of October 24th, 1929, the heart of global capitalism stopped beating. For nearly a decade, the streets of Manhattan had been paved with a different kind of gold. Not the physical bars locked in the vaults of the Federal Reserve, but a collective, feverish delusion that the numbers on the ticker tape could only ever go up. We call it the Roaring Twenties, a period often remembered for its jazz, its glitz, and its defiance of prohibition. But beneath the champagne bubbles and the flashing lights of Broadway, a much darker engine was humming. It was a financial machine designed to manufacture wealth out of thin air, and it was about to run out of fuel. The decade began in the shadow of a great war, but as the 1920s progressed, a new religion took hold of the American psyche. It was the religion of the market. For the first time in history, the average citizen, the barber, the seamstress, the steelworker, was convinced that the stock market was not a den of gamblers, but a reliable ladder to the upper class. The barrier to entry had been systematically dismantled by a mechanism known as buying on margin. It was a simple, seductive trap. You didn't need the full price of a stock to own it. You only needed 10%. The brokerage would lend you the rest, fueled by a relentless flow of easy credit. In this world, $1,000 of savings could control $10,000 of destiny. As long as the market rose, everyone was a genius. As long as the music played, the debt didn't matter. But the music was being composed by men who understood the fragility of the rhythm. Figures like Charles Mitchell of National City Bank and the Titans of Wall Street had transformed the stock market into a high-pressure sales floor. They weren't just selling shares, they were selling a dream of permanent prosperity. By 1929, the total amount of margin loans had reached staggering levels, exceeding the amount of actual currency in circulation. The entire American economy was a skyscraper built on a foundation of IOUs. The tension was invisible, but it was absolute. The first cracks didn't appear on the floor of the New York Stock Exchange. They appeared in the silent, empty spaces of the American heartland. While the cities were celebrating, the farmers were drowning. Wheat prices had collapsed, and rural banks were quietly shuttering their doors, one by one. The industrial engines of the Taumer North began to stutter as warehouses filled with goods that nobody could afford to buy. The consumer had reached their limit, yet the stock market continued its vertical ascent, detached from the reality of the factories and the fields. It was a speculative bubble of such magnitude that it required a constant increasing injection of new players and new money to stay inflated. In the late summer of 1929, the atmosphere changed. The air became heavy with an unspoken dread among the elite. A few savvy insiders began to quietly liquidate their positions, slipping out the back door while the public was still clamoring to get in. The Federal Reserve, sensing the approaching storm, raised interest rates in an attempt to cool the overheating engine. But it was like trying to put out a forest fire with a glass of water. The momentum of greed was too great. On Thursday, October 24th, the opening bell rang at 10:00 a.m. and the world shifted. There was no gradual decline. There was only a void. A massive wave of sell orders hit the floor, and for the first time in a decade, there were no buyers. The ticker tape, the only lifeline of information for investors across the country, began to fall behind. Minutes turned into hours. In the silence of the delay, panic took root. Men stood on the floor of the exchange, watching the prices vanish into a black hole of uncertainty. They realized that the wealth they thought they possessed was merely ink on a page, and the ink was fading. By noon, 11 prominent financiers met in secret at the offices of J.P. Morgan. They knew that if they couldn't stop the bleeding, so the entire global order would hemorrhage to death. They prepared a desperate multi-million-dollar gamble to save the market, but they didn't realize that the panic had already moved beyond their control. The monster they had created was no longer listening to its masters. The temporary intervention of the banking titans on that Black Thursday appeared for a fleeting moment to have worked. Richard Whitney, acting on behalf of the Morgan Pool, strode onto the exchange floor and placed a massive bid for U.S. steel well above the current market price. It was a calculated display of confidence, a signal to the masses that the giants of industry would not let the floor collapse. The bleeding slowed. The panic retreated into the shadows. For a few days, the world held its breath, hoping the fever had finally broken. But the wound was deeper than any single injection of capital could heal. Over the weekend, the realization began to sink in across the dining tables of Middle America. The illusion of safety had been shattered. By Monday morning, the psychological dam finally gave way. The sell orders weren't coming from the speculators in the mahogany offices, they were coming from the margins. The brokers, seeing the value of their collateral evaporate, began issuing the dreaded margin calls. They needed cash, and they needed it now. When the investors couldn't pay, the brokers were forced to liquidate those shares at any price they could get. This triggered a lethal feedback loop. Every forced sale drove the price lower, which triggered more margin calls, which led to more forced sales. The market was no longer a place of commerce. It had become a meat grinder of wealth. Tuesday, October 29th, arrived like a funeral shroud. It would go down in history as Black Tuesday, the day the bottom fell out of the American dream. Within the first few minutes of trading, the volume of shares being dumped was so massive that the ticker tape, the only source of truth for the outside world, fell hours behind. Investors in Chicago, San Francisco, and London were flying blind, selling in a vacuum of information, driven by nothing but primal fear. The floor of the New York Stock Exchange descended into a scene of choreographed madness. Men screamed until their voices failed, clutching slips of paper that represented life savings, family homes, and future security, only to find that those papers were now worthless. Behind the chaos on the floor, a more systemic rot was being exposed. The banking system itself was cannibalizing its own foundations. In the 1920s, there was no firewall between commercial banking and investment banking. The money that ordinary citizens had deposited for safekeeping had been used by the banks to play the market. As the stocks tumbled, the banks' assets vanished. The very institutions meant to be the bedrock of the economy were suddenly insolvent. The people, sensing this betrayal, began to gather outside the bronze doors of their local banks. They didn't want interest. They wanted their principal. They wanted the physical cash they had been promised was always there. But the cash wasn't there. It had been lent out to speculators, invested in failing railroads, and tied up in the very margin loans that were now being wiped out. As the bank runs began, the Federal Reserve faced a choice that would define the next decade. They could have flooded the system with liquidity to stop the chain reaction, but they chose a different path. They chose to protect the value of the dollar and the gold standard at the expense of the people. They tightened the money supply when the world was starving for it. It was an economic strangulation, a slow-motion execution of the global credit market. By the end of that horrific week, $30 billion in wealth had simply ceased to exist. To put that in perspective, that was more than the United States had spent on the entirety of World War I. But the crash was merely the opening act. As the smoke cleared from Wall Street, the realization dawned that the financial collapse was migrating into the real economy. Factories began to go silent. Orders for steel and automobiles were canceled overnight. The invisible threads of credit that connected the manufacturer to the consumer had been severed. The Great Depression was no longer a threat. It was a reality that was settling over the nation like a thick, suffocating fog. The world was about to learn that when the elite play with the mechanics of money, it is the common man who pays the ultimate price in breadlines and broken lives. The crash of 1929 was not merely a singular event of financial loss. It was the shattering of a global architecture. As the 1930s dawned, the Great and Great Depression began to earn its name. The shockwaves traveled across the Atlantic, toppling the fragile economies of Europe that were still rebuilding from the scars of war. In America, the statistics became a haunting tally of human misery. Unemployment, which had been a negligible factor in the Roaring '20s, exploded to 25%. 1 out of every 4 able-bodied men stood in breadlines, their dignity dissolving in the steam of thin soup. The aftermath revealed the true nature of the scam. As the dust settled, it became clear that the wealth hadn't just vanished into the ether. It had been redistributed through a brutal process of consolidation. Small banks, over 9,000 of them, collapsed entirely, wiping out the life savings of millions who had never even touched a stock. The large money center banks, however, used the crisis to swallow up their competitors for pennies on the dollar. The power of the financial elite didn't disappear. It simply became more concentrated. The middle class was hollowed out, while those with liquid capital at the bottom of the crash found themselves in a position to buy up the nation's infrastructure at fire sale prices. The historical lesson of 1929 is a warning about the danger of unbridled credit and the illusion of permanent growth. It taught the world that when the gap between the financial markets and the real economy becomes a canyon, the entire society eventually falls into it. We see the echoes of 1929 in every modern bubble, from the dot-com burst to the subprime mortgage crisis. The mechanisms change, the technology evolves, but the human psychology of greed and the systemic reliance on debt remain identical. We are still living in a world defined by the regulations born from that wreckage, yet we continue to push the boundaries of the same financial engineering that led to the abyss. The skyscrapers of Wall Street still stand as monuments to that era, but they are also tombstones for the millions of lives upended by a decade of darkness. The Great Depression proved that the economy is not a natural force like the weather. It is a human invention, and when its gears are rigged to favor the few, the many will eventually be forced to pay the debt. History shows us that those who do not respect the gravity of debt will eventually be crushed by its weight. To understand the future of money, we must first understand its past. Subscribe to uncover the truth.